Many wonder how to make money by copying Warren Buffett. Well, there's a guy who did it. His name is Mohnish Pabrai. He earned billions of dollars by simply copying Warren Buffett's investment strategy. He even wrote a book about it, The Danto Investor. In some ways, Pabrai has taken Buffett's value investment concept and amplified it. In this video, I'll sum up for you the most important takeaways from his book. But first, who is Mohnish Pabrai? He was born and raised in India before he moved to the United States for higher studies. He began his career as a software programmer, but quickly transitioned to entrepreneurship, establishing his own IT business, which he sold a decade later. Then, Mohnish launched the Pabrai Investment Fund with an initial investment of $1 million in 1999. His fund achieved cumulative returns of 517% in just 14 years, delivering annualized returns of approximately 25%. Today, he manages over $1 billion in assets. Mohnish Pabrai has been careful and calculated in his attempts to copy Warren Buffett's style. He realized Buffett had mastered the game of compounding to double his money multiple times. What Mohnish Pabrai chose to do was pick the most skilled player in this particular game, study why he was so good, and then meticulously replicate his strategy. As he once said, "I'm a shameless copycat. I have no original ideas." Having achieved a stunning success, he famously paid $650,000 to have lunch with Warren Buffett in 2007. Now, let's move on to the valuable principles for investing he shared in his book, The Danto Investor. In the book, Mohnish describes 9 principles for low risk and high returns. First, focus on buying an existing business. Why? Because it's simply much less risky to buy an established business with a proven track record than a startup. Having an ownership stake in a few businesses is the best path to building wealth. So, the best place to buy an existing business is a stock exchange. In the stock market, one can start even with a small amount of investment. Over the last 100 years, stocks have provided higher returns than all other major asset classes like bonds, gold, and real estate, especially when accounting for the power of compounding. Number 2. Invest in simple businesses, in industries with slow rate of change, that are easy to understand. To assess if the company is cheap or expensive, first you have to estimate its intrinsic value, for example with the discounted cash flow method. To improve the reliability of these calculations, one needs a stable, simple, and predictable business to avoid having an excessive uncertainty in valuation. Therefore, Mohnish sticks to industries he knows very well and where he can make decently reliable predictions of future sales. Therefore, like Warren Buffett, he passes on most of the opportunities just because they are not right in his circle of competence. Buffett is well known for his thoughts on staying within your circle of competence, as he put businesses too complex to understand easily on the famous too hard pile in his office. Buffett loves simple businesses like Coca-Cola, See's Candies, railroads, insurance companies, etc. Consequently, both Buffett and Pabrai stay with a fairly concentrated portfolio of simple companies with a slow rate of change. So, never invest in a business you cannot understand. 3. Invest in distressed businesses, in distressed industries. Struggling businesses, those suffering from temporary problems, can present significant investment opportunities. If the core fundamentals of the business remain intact despite its temporary setbacks, investors can often buy them at a bargain price and benefit from the eventual recovery. "I'd be a bum on the street with a tin cup if the markets were always efficient," is a famous quote by Warren Buffett. While the market is generally efficient, Pabrai believes that investors can carefully find the situations where it is not. When a company or industry is in trouble, it can often sell at a substantial discount to its intrinsic value due to widespread fear in the marketplace. There are several ways for investors to find struggling companies. For example, media headlines are often filled with negative news and outlooks for specific companies or industries. Another useful tip is to look for the stocks with the lowest price-to-earnings or price-to-book value ratios. Investors should look for companies whose problems are fixable, rather than those facing insurmountable challenges. By investing in distressed assets with strong fundamentals, investors can often buy them at deep discounts. 4. Always invest in business with durable moat. By moat, he means competitive advantages that last for many years. It could be brand, technology, cost advantage, scale, network, and so on. Sometimes the moat is clear, other times it may be hidden. There is a vast list of businesses with durable moats like Coca-Cola, American Express, Google, or BMW. But it is important to notice that all moats erode over time. Even apparently unbeatable businesses may ultimately decline. Do you remember Nokia? Therefore, it is important to carefully recognize prospects for success of a given company. 5. Few bets, big bets, and infrequent bets. Unlike the commonly held belief in diversification, Pabrai argues that investors should concentrate their portfolio on their best ideas. By betting big on a smaller number of high-conviction investments, investors can maximize their potential returns. Pabrai is not an advisor on investing often. Instead, investors should allocate disproportionate amounts of money when the odds are clearly in their favor. How much an investor should bet on a given opportunity? Pabrai recommends using the Kelly formula to calculate optimal fraction of capital to bet. One might invest up to 40% of a portfolio in a single security under conditions coupling an extremely high probability of correct reasoning with a very low probability of that anything could change the underlying value of an investment. As a result, his portfolio is very concentrated, with no more than 10 securities, usually much less. As Charlie Munger once said, "The wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time, they don't." It's just that simple. 6. Fixate on arbitrage. Investors should use arbitrage, especially in those situations when downside risk is eradicated. There are several types of arbitrage, for example, mergers, pricing inefficiencies, discrepancies between stock exchanges. With proper research and an understanding of the specific deal, arbitrage can be a profitable and safer investment strategy. 7. Ensure a margin of safety. Always. Margin of safety is a principle introduced by Benjamin Graham in his book, The Intelligent Investor, and popularized by Warren Buffett. This concept involves buying stocks at a price below their intrinsic value to create a buffer against unforeseen risks. By purchasing investments at a discount to their true worth, investors protect themselves from significant losses if things go wrong. The idea is to look for market inefficiencies, the low-risk, high-reward situations, and use them. Pabrai cites an example of Warren Buffett's investment in Washington Post shares. In 1973, based on price-to-earnings valuation, the company was worth approximately $400 to $500 million. Meanwhile, the stock market valuation at that time was only $100 million. This is how Buffett bought Washington Post shares for 1/4 of their value. He used the principle presented by Benjamin Graham to buy shares of good companies when they can be bought at a price way below their intrinsic value. Quoting Buffett, "Make sure you are buying a business for way less than you think it is conservatively worth." 8. Invest in low-risk, high-uncertainty businesses. High uncertainty does not mean high risk. Market will often elude companies with uncertain prospects. People don't like uncertainty. This is what allows value investors to jump in and earn excessive profits. A recent example was the pandemic. when many companies with strong fundamentals were significantly discounted. For example, shares of ExxonMobil in March and November 2020 were trading way below the net worth of its assets. 9. Invest in the copycats rather than innovators. Many investors are looking for the next big innovation that will make them rich. On the contrary, Pabrai argues that instead of focusing on innovators, investors should rather focus on companies that excel at copying and scaling. This is a much safer approach. There are many examples of companies that successfully extended the innovations of others. One of them is McDonald's. Ray Kroc didn't invent the concept, but saw its potential and bought a restaurant from its founders, the McDonald brothers. Later, he developed the company into its current form. An even better example is Microsoft. Microsoft's own inventions often fail, but it is when they take the existing ideas of their competitors and improve them that they are the most successful. It took the graphical interface idea from Apple, networking from Novell, Internet Explorer from Netscape, Xbox from PlayStation, and so on. Pabrai also stresses the importance of learning from successful investors like Warren Buffett and Charlie Munger. He suggests that investors should copy the strategies of these successful individuals, not by copying their specific stock picks, but by understanding the principles that guide their decisions. Cloning successful strategies increases the likelihood of achieving success. Well, Mohnish Pabrai has proved it works. Thank you for watching. If you liked it, subscribe.